Good evening and welcome to the Money Show. I'm Kavita Thapliyal and let's begin and dive deep into the world of personal finance, a topic that affects all of us no matter where we are in our financial journey. Whether you're just starting out with your first paycheck or planning for retirement, understanding how money works is essential for achieving your financial goals and securing your future. In this show, we'll break down complex financial concepts into simple, actionable advices. We'll talk about saving, investing, budgeting, and everything in between, all with the aim of helping you make smarter decisions with your money. From tips on growing your wealth to strategies for protecting your hard-earned cash, we've got you covered. But that's not all. Every week, we'll bring in expert industry leaders and real-life stories to help you navigate your financial life with confidence. So whether you are looking to build your emergency fund, plans for major life goals, or understand the latest investment trends, this is the show for you. So sit back, relax, and get ready to take charge of your finances because it's time to talk money on the Money Show. All right, so let's begin. And this also gets us to the focus where we do your financial planning on the show. So just in case you are wondering that how to get your financial portfolio checked, you can send across your questions on our WhatsApp number, which is 8657974571, and we also have an email ID where you can send across your question. The email ID is themoneyshow@etnow.tv. Okay, so let's begin the show, and we'll begin the show with a very special initiative. The beginning of the month often marks key financial activities, salary credits, bill payments, and planning expenses. But just as we plan for our expenses, it's equally important to plan for our investments. To encourage this habit, SBI Mutual Fund, in collaboration with Times Network, is launching a nationwide investor awareness initiative, Bharat Nivesh, Behtar Kal. The objective of this initiative is to promote the habit of consistent investing among Indians, helping them secure their financial future. Now, as part of this campaign, we observe 4th of every month as a monthly reminder to ensure that you start your mutual fund SIP or ensure your existing SIP continues. So go on and set your reminder to invest consistently and stay committed to your goals for the financial well-being of you and your loved ones. And as per this particular campaign, every Thursday on the Money Show, we pick up a very important investment topic that helps you go ahead in your financial journey. And today we'll be talking about something very important. We are diving into a significant proposal by SEBI that could shape the future of investing in India. We'll also flash some graphics on the screen so that you can read the proposal as well. We are talking about SEBI's proposal for the creation of life cycle funds of fund, a new concept aimed at helping investors align their investment strategies with their financial goals over time. Now, according to SEBI's proposal, these funds will follow a target date model, meaning they will gradually adjust their asset allocation as the target date approaches. Now, initially, these funds will be equity heavy, and as the target date nears, they will gradually shift towards more conservative options like hybrid funds or ultimately debt funds. The idea is to allow investors to plan according to their investment horizons and goals with the clear strategy of risk reduction over time. But the question is, this approach, can it really work for an Indian investor? And how will it impact the way we think about mutual funds? Let's explore this concept in detail, address some very critical questions surrounding it. With me, I have Kaustubh Belapurkar from Morningstar to elaborate more on this. Kaustubh, good evening, and thank you so much for taking out time for this very crucial discussion and a very important initiative by SBI Mutual Fund and Times Network. Now, I really want to understand this SEBI's proposal now of life cycle fund of fund. Do you think it's the need of the hour? And also, what's the current context over here? Because we're talking about the shifting of asset classes also, the shifting of asset allocation also. A lot of time, investors find it very difficult to understand the nature of one particular asset class. And over here, depending on the time duration, they'll be changing the asset classes. How can we look at it, and how similar is it, to a multi-asset allocation fund where you have the benefit of different asset classes? Maybe, is that a better option maybe? So, yeah. A lot of questions in one.
Sure. Thanks, Kavita. Thanks for having me on the show. And I'm really excited to be talking about this proposal because I think this is, this is very interesting and very relevant from the context of, what the investing journey that many investors have been kind of been moving towards, right? In fact, even the show that you kindly hold, where you get the investor queries, there are a lot of queries that investors themselves come and say that I have a 15-year, 20-year, 30-year horizon. I want to plan for my retirement or certain goals, and can you help me build a portfolio? Now, remember, asset allocation is key to the way a portfolio is built. We always talk about it, but asset allocation should never be static, right? It should always be a moving target depending on when your goal is about to come. And the closer you get to your goal, asset allocation should become a little more conservative. That's typically the way you would think about the way asset allocation works. Now, what has SEBI outlined in their proposal is essentially that they will look to allow fund houses to create what they call life cycle fund of funds with certain target dates, right? So these target dates, what they've put down in the proposal paper saying that, every 5 years up to a maximum of 30 years, you can have target date funds. And, so for instance, you can have a target date fund of 2035, 2040, 2045, and so on and so forth, to a maximum tenor of 30 years, right? So investors can match that, what my goal time period is. If I'm an investor today who thinks that I have a 25-year goal for retirement, I can buy into a target date fund that matures, say, around the year 2050. And what that target date fund will do is take away the trouble of doing the asset allocation on my own. It will put it in a way in an autopilot mode, where I start with the most aggressive allocation, which is equities, right? High risk, high return. We know that. Great asset class over a long investment horizon. But as I get closer to my target date, so if my target date is 2050, the fund will automatically 6 years prior, that's SEBI's proposal, start moving from equity funds to first hybrid funds. So it is a mix of equity and debt. And over the last 3 years, it will move into fixed income funds, is what the proposal states, right? So into a more conservative, perhaps lower returns, but more safer, less volatile asset class, so that your capital or whatever you've created, the wealth you've created, is largely protected as you come closer to your investment goal. So I think in that sense, it allows investors to find one route to make their asset allocation, which moves as per their own investment goals. The key difference, like you said, we have a lot of hybrid funds that are already there, and extremely well managed funds, if I may add, multi-asset, dynamic asset allocation. The key difference is that allocation will always remain depending on the strategy of the class. It does not take into account the investor's unique circumstance, right? So for instance, if I have a goal which is 5 years down the line, I might not want to be in an aggressive allocation fund, because obviously it is very, very equity heavy. And I want to get into an allocation fund, maybe like a conservative allocation fund, which will be more towards fixed income. Now, life cycle fund will automatically adjust that, because 5 years left, I will be in a hybrid fund, which is probably more fixed income allocated rather than equity. So I think that is the beauty of the proposal. Obviously, more details are awaited. This is only a consultation paper right now, but I think it's exciting times for investors to take a step towards how you can create more structured investment goals and meet them with a reasonable amount of certainty.
All right. So Kaustubh, I really understand the gradual shift that you're talking about, across asset classes that one might see. It's really helpful as far as managing your risk is concerned. But these days, the kind of investors we are looking at, even senior citizens are very much comfortable investing their money in equity. So what if someone is a much more risk taker? For them, maybe this kind of a product is not the right solution?
Obviously understanding. And let me draw a parallel with what exists in the global markets right now, which is the target date funds, which are a very popular asset class. In fact, in the US market, close to about 4 trillion of assets. So that's like 5 times the Indian fund industry right now sits in target date funds in the US. It's a very popular category, with investors who are looking to, again, save for a goal. The current approach which is followed is a glide path approach, which essentially says that we'll start equity heavy, we will bring it down, similar to what SEBI is proposing, but it will not necessarily take, say, equity exposure down to zero. So that's something I'll be interested in understanding as the fine print and the sort of the clearer regulations once their launch come out. That is it going to be completely away from equity, or will you still allow some dispensation for equity? But you're right, if the case is that investors still wants a significant asset class, because every person's personal financial situation is unique. If I have a steady retirement income, maybe from a pension or some other source, I don't need to move to a very conservative asset class. But this allows you to, for investors who want to be conservative, to get into that sort of a product. Obviously, you can have this product along with other products such as equities, depending on your unique asset allocation framework. But this allows you an autopilot mode, which is where the usefulness of the product comes in.
Uh, uh, so, having said that, what kind of investment product would you compare this with? If we just remove the annuity part from an NPS, does it sound more similar?
Uh, in a certain sense, yes, because it's, in NPS also, I mean, they have a kind of trigger in terms of, but it's more of a bullet trigger where it'll come down from a certain percentage to a certain percentage on the equity side. Uh, in most cases, and again, I would love to see how that, is kind of driven by SEBI's mandate, but the whole glide path approach, and if I draw a parallel with how we land an aeroplane, uh, when you're at a cruising altitude and at cruising altitude speed, when you're about to land from very far off, you slowly start reducing the speed of the aircraft and the altitude so that you can make a safe landing on the runway, right? Uh, Target date funds are very similar in their glide path approach, where you'll start equity heavy, you will slowly start bringing it down. So it's not like you start from 90% or 100% equity and you bring it down to 50% in the matter of one shot. Maybe 5-10 years before the target date, you would bring it down gradually 5% points and then exponentially start bringing it down as you get closer to your target date. So I think the glide path approach, and hopefully that's something that will also be followed in these strategies, will make more sense because that will take care of a much more seamless asset allocation, and also then make sure you maximize your opportunities in the portfolio.
Now, as far as the equity part is concerned, or just going heavy on equity time frame is concerned, what's going to be the strategy, and what will be the alpha earning strategy for the fund manager if that would be the case?
Yeah. So, what again, the proposal is essentially right now saying is that, say if you have a, 30-year target date fund, the first 24 years will be purely equity. Now, it's not clear as to, I think the mandate within equity, which types of funds, will lie with the asset manager in deciding amongst their bouquet of strategies. Now, globally, what we've seen is passives actually form a very large part of several of these target date funds. So it's a more predictable outcome for the investor. They're cheaper options, obviously. But that's still, I think it is the purview of the investment manager. The way they want to run the equity strategy amongst their fund bouquet. And then they would then obviously shift to their hybrids and their allocations. So there's definitely opportunity to add value through moving across the market capitalization curve, or through actively managed strategies within the fund-to-fund bouquet on the equity side. And the beauty, like I said, is in the long term, when you're invested in equities, which can be volatile in the short term, but obviously if you have a 20+ year target date fund, the first 14 years, equities will compound pretty significantly. You've created a large amount of capital, and then you start preserving it and moving into a preservation mode through hybrids and eventually fixed income investments, which will give you surety of sort of of income and not too much volatility.
How do you think these kind of funds would be taxed?
Now that's hard to say right now, but obviously, I mean, tax situations keep evolving, so I think I want to keep a close eye on that. But how that will eventually come out. But obviously, in the initial years, as taxation stands today, it would probably still be an equity-oriented strategy. But as it goes closer, so I don't want to comment on that because obviously, these things can change, and we'll wait for the regulatory guideline on that.
All right. So, hybrid is the way ahead. That is what we are looking at also, at least the investor interest and the trend. That is what it says. But having said that, what kind of an investor should be having such kind of a fund in their portfolio? I mean, it's still at a proposal stage. Fund houses need to consider a lot of other factors as well. But then, having said that, if we have something like this, how should one place it in their portfolio in terms of exposure, in terms of aligning it with the financial goal? What all things need to be considered then in that case?
Yeah. So a couple of things which are important, right? So one is you could align it to a single goal. Like, for instance, you want to buy a house, or for an education, just 10 years down the line, you can buy a 10-year target date fund, which is purely just to fulfill that goal. Now, with this sort of jacketed exposure across asset classes, and especially because in the last 3 years you will be in fixed income, I would say it adds a fair amount of certainty in terms of where your portfolio value will end up being around the goal time, at least in terms of it's not going to see extreme volatility, given that you'll have fixed income exposure in the last 36 months. So I think in single goal applications, there's a great use case. Even for longer sort of retirement goals, it can definitely be a great source of kind of having a pool ready for you at retirement. Obviously, I think the beauty of what investors need to think about when they're doing their math, their own personal financial math, because that's something they'll need to do in terms of what is the kind of money they need, what is going to be the allocation. Because the biggest one oversight that happens when we do portfolio planning or asset allocation, we think about asset allocation sometimes as a static concept. We do our return estimations also based on the static concept that equities is going to perhaps give me X%, and I will assume that over the period of time. But remember, if you're going to step down your equity exposure, move into fixed income, which is going to yield lower, obviously your portfolio overall returns will be low. So I think that is also something that investors will keep in mind when they look at target date funds, because they know for sure that I'm going to move away from, say, 100% equity to 50-50 and perhaps 0% equity as I come closer to my target date.
All right, I think with that, it's all on the target fund of fund part is concerned. But then let's move on and let's get connected with our viewers. In fact, let's start answering the portfolio queries, Kaustubh. And before we do that, let me flash our WhatsApp number and email ID so that all the viewers who want to get their financial portfolio queries answered by our expert, you can send across your questions on 8657975.